Words may inspire, but action creates change. Good morning, everyone. A warm and hearty welcome to each and everyone here. It is a very delightful moment to have such an eminent resource person for today's session. And special thanks to Dr. Prabhu Dev, who has graced his presence and for sharing his valuable time with us. We are grateful to our Honorable Dean, Dr. Bindu Nambiad Ma'am, for giving us this opportunity to organize this event. And I would like to welcome our event coordinator, Professor Nityananda Sir, our beloved teachers, and my dear friends. Once again, a hearty welcome to one and all. It is mark of our underlining tradition to play Ramaya anthem at the beginning of an important events. So now I request to play Ramaya anthem.
विनयभूषण रामय्य समूह संस्थान ज्ञान विद्या विनयभूषण रामय्य समूह संस्थान भारते भारते जय वेंकटमयी संस्थानके ಕಷ್ಟಾರರು ಕಟ್ಟಿದ ಕನಸಿನ ಸಾಮ್ರಾಜ್ಯವಿದು ದೀಪಗಳು ಪ್ರದೀಪಗಳ ಬೆಳಕಿನ ಶ್ರದ್ಧಾಸ್ಥಾನವಿದು ವೆಂಕಟಾಚಲೇ ಜಿಗಿಯುಗ ಸಂಪನ್ನೋಲವಿದು ಗೃಹಗೃಹದಲ್ಲಿ ಸಹನೆ ಕಾಣುತ್ತೆ ತಂತ್ರಜ್ಞಾನದ ಸೋಪಾನವಿದು ಅಮಿತ ಜ್ಞಾನಕ್ಕೆ ಸಾಧನ ಕ್ಷೇತ್ರವಿದು ಪ್ರತಿಭೆಯ ಸಾಧನೆ ಮಾಡಲು ಸ್ಫೂರ್ತಿಯ ಕೇಂದ್ರವಿದು ಅಜ್ಞಾನದ ಕತ್ತಲೆ ನೀಡುವ ಸಜ್ಞಾನದ ಸೂರ್ಯನ ರಶ್ಮಿದು ಬೆಳಕನ್ನು ಚೆಲ್ಲಿದೆ ಅಸಂಖ್ಯಾತ ಕಿರಣಗಳು ಹೊಮ್ಮಿವೆ ಜಯವೆಂಕುವ ಈ ಸಂಸ್ಥಾನಕ್ಕೆ
It's our pleasure having Dr. Prabhu Dev for this session. He is Senior Academician, Professor and Director, MCM Bengaluru. His qualifications: MCom 1976 First Class, MBA, LLB, PhD in Finance 1992-94 Bengaluru University, and also certified as Corporate Director. Sir also published 8 books, research papers 30, articles 40. He also worked as research guide for 8 PhD and MPhil, and resource person in sponsored FDPs in 6 times. National and international conferences has inaugurated, chaired technical session and participated 22 times. Sir visited 6 universities abroad and also visited 20 countries. Honors, recipient of different awards for the outstanding contribution to education and society. The latest being Lifetime Achievement Award, outstanding contribution in domain of education. Shiksha Ratna, a Soviet titled Prabuddha, was bought out in the year 2016 by former students and well-wishers on the occasion of Dr. V. Prabhu Dev completing 4 decades in academics. Now I request Dr. Prabhu Dev to take over the session, sir. Over to you, sir.
Good morning. What a
Good morning,
beautiful
sir.
morning to interact with youngsters and my academic friends. It is a very beautiful topic, very contextual, very relevant topic. I'm happy to offer my inputs and stir a thought process among the participants where you can take your learning to the next level. I think all of you are aware of the topic. I would like to share the topic and the PPT, what I have, the inputs, what I have. Yeah. Yeah. Maximizing shareholders' value through good financial reporting. As the students of finance, I am sure by now you would have formed your opinion about financial reporting, what a good financial reporting is all about. However, there is a lot of learning because the canvas is so wide. Financial reporting involves multiple ramifications. It involves ethical dimension. It involves professionalism, and it involves honesty dimension. So it is very important for us to go through what a good financial reporting all about and how it is going to impact the investor community, perhaps the economy to a larger extent. Now, all of you are aware, this lecture is being discussed in the backdrop of listed companies. You are aware, that is the basic presumption. And what do you see in a listed company? It is owned by shareholders, investors, but managed by may not be the investors themselves. The investors who invest money in a company belong to different walks of life, belong to different vocation, profession, and they just rely upon the inputs offered to them by the directors, by the management. So which means the money belongs to the shareholders, the funds belong to the shareholders, and the management of the funds will be done by another team. This you know it. So which means there is a separation of ownership and management. And who manage the company? The directors. As all of you are aware, the directors are the elected representative of the shareholders. What do? They manage the company, in simple thing. But in reality, do they manage the company? They're supposed to manage the company because they enjoy fiduciary position. They are like the trustees. They enjoy the trust of the shareholders because the shareholders believe them. The shareholders would have handed over their hard-earned money to the company, to the team, called board of directors, and who the board, singular, the board is expected to handle the funds of the shareholders in the most professional manner, in the most ethical manner, because they are the trustees. But in reality, we see a different aspect in reality. Quite often, the funds of the shareholders are not utilized for promoting the interest of the company. On the contrary, we are seeing many cases where the shareholders' funds are diverted to promote self-interest of the shareholders. This is the ugly side of the financial reporting, if I should say. Are you able to hear me? Hello?
Yes, sir.
Yeah, good. Today, what is happening? What the shareholders expect from the company? Those were the days the shareholders were happy as long as they received a good dividend, as long as there was an appreciation in their shareholding value. They were just happy. But today it is a different thing altogether. And as you are aware, in the year 1991, when the globalization was announced, besides liberalization, it created, it offered a different spectrum altogether. And the shareholders' expectation start soaring. And today the shareholders are extremely knowledgeable, extremely aware, active. You find shareholders' activism so much, they can reject an important resolution of the company. That is the power of shareholders. So the shareholders' expectation is going up with every passing day. This has prompted companies to be extremely cautious, and they have raised the bar. They have raised the standard of financial reporting. That is the minimum thing which companies should be doing because of the globalization. And you have fair knowledge by now. I think the shareholders have multiple choice of countries to invest because of globalization. Those were the days. Shareholders in India were investing only in Indian companies. But now, Indian shareholders can invest in companies abroad, foreign companies. Similarly, you find many MNCs operating in India. And because of this, shareholders constantly compare companies with each other. And for them, what is important? The company which is best in terms of financial reporting, in terms of internal control system, is the company of their choice. In case they feel that the company where they have invested is not professionally handling their money, in case they get out of their investment and go for a company which is well managed, go for a company where they feel that their money is safe. And today, you know very well that corporate governance practices are adhered to by companies. Companies are waving with each other to adhere to corporate governance norms because public image is very important. In addition to the statutory compliance, they're going beyond law. And multinational companies, they have very good reputation by and large in adhering to corporate governance norms. Indian companies are not lagging behind because they're forced to adhere to corporate governance norms, and the shareholders constantly watch companies in terms of their corporate governance, the degree of corporate governance adherence. And another important thing is that employees also have a choice, like shareholders. Employees keep looking for good opportunities, and employees would like to be a part of a company where the funds of the shareholders are handled ethically, professionally well. After all, they don't want to be a part of the company where they may lose their job because of unethical practice. And the management will foster a belief system among the employees. After all, they are given the mandate by the shareholders to manage their funds. So what they do, the management has to motivate the employees, motivate the team, and create an awareness that every rupee saved translates to multiple rupees in market capitalization. I think all the students here, all the participants know what is market capitalization. Every single rupee saved will contribute, will translate to multiple rupees in market capitalization. Therefore, the way the team in the company, consisting of employees, managers, and others, contribute goes a long way in fulfilling the shareholders' expectation. Financial reporting. And you know, you have learned in your managerial accounting that all companies will come out with annual financial systems, statements, income statement, what we call statement of profit and loss. You know very well, profit and loss statement is very, very important, not just for shareholders, for others, for lenders, for government, for the tax department. After all, the tax amount depends on the profitability of the company. And the shareholders keenly look for the bottom line. What is the bottom line? The profit. After all, the dividend on the shares depend on the profit made. Dividend can be paid only out of the profit, not from any other source. You know it very well. Therefore, profit and loss statement is an important statement. It's a very important statement from the perspective of the stakeholders, including the shareholders and lenders, government authorities, regulators, others, balance sheet is also very important. What is the difference between profit and loss account and balance sheet? The profit and loss account, as the nomenclature goes, is for the year ending. That means it gives profitability picture for that financial year, for that accounting year. Whereas balance sheet, you see the nomenclature, balance sheet as on, which means the balance sheet gives a picture of the entire asset and liability position of the company till now, from the date when the company commenced its operation on day one. It gives an aggregate picture. It gives a consolidated picture till now. It shows assets and liabilities. Assets constitute what the company owns, and liabilities constitute what the company owes. You have studied a lot about balance sheet. But these are very important. Income statement, that is profit and loss statement, and balance sheet are very, very important from as a part of the financial reporting, because the shareholders want these two basic statements. And the Institute of Chartered Accountants and mandates that every company where the turnover is more than 50 crores is supposed to come out with a statement of cash flows. These are the three statements what you normally find in the financial reporting as a part of financial reporting. What you get in this statement, in this financial reporting, what information you get? You get information. When I say you, the stakeholders, including the shareholders, you will get information where you can evaluate the performance and prospects of the company. Performance in terms of profitability, performance in terms of how the asset is enhanced, that those are the performance. And if you can project it to the succeeding years, maybe both in the short term and long term, it will help managers, it will help all stakeholders, including government. And one more thing you should know, this financial reporting offers a huge scope for analysis, financial statement analysis. You have learned analysis, you are studying analysis also. Analysts, they rely heavily on the financial reporting. Analysis could be simple, could be very comprehensive. When you keenly analyze, effectively analyze the financial reporting, you will be able to assess the corporate excellence. You will be able to judge the creditworthiness of the company, and the bond rating also depends on the contents of the financial reporting, the appropriateness of financial reporting. And not just that, it will help you to evaluate intrinsic value of equity shares. The financial reporting analysis also will help us to come out with the intrinsic value of equity shares. And not just that, good financial reporting will help us to assess the possible market risk. And nobody is free from risk. In fact, risk is an assumed aspect in business, is an integral part of the business. Perhaps there is no business on earth where there is no risk. Financial reporting, good financial reporting, will help us to analyze properly, to assess the market risk, the possible market risk of the company, which is faced by the company. Today, it is a VUCA world. What is VUCA world? Uncertainty, volatility, complexity, and ambiguity. Whereas the windscreen is quite hazy. Windscreen is not very clear because totally unexpected events may happen. Volatile events may happen. Complex things may be there. I'm talking about risk. And it is quite ambiguous. Therefore, financial reporting, if you can analyze it properly, it will help you to get a clear picture of what is going to come in the near future, at least in the near future. Therefore, active investors can decide whether they can continue with their investment in the company or whether they should get out of their investment. So this is one important aspect of financial reporting. And talking about other aspects of good financial reporting, as I told you, it will give information about financial position, definitely, and changes in the financial position. It will also help us to assess the fairness, the degree of transparency, and the degree of accountability to all the shareholders, including all the stakeholders, including the shareholders. And we are talking about shareholders' value. The value of the shareholding should be maximized. That is the objective of good financial reporting, not just for this year, on a sustainable basis. And financial reporting should not give any false hope, no misleading information, you know very well. And there should be good internal control system. When we say good financial reporting, what comes to your mind is profit and loss statement, balance sheet, statement of cash flow, and all that. Okay. But the thing is, what is not seen, what is hidden is the internal control system. It is only internal. It may not be obviously seen through the financial reporting. Therefore, good companies, professionally run companies where ethical, that is effective and efficiency of operation. And not just that, it will help. Good internal financial reporting will help to assess the reliability of financial reporting. Oh, the financial reporting, is it reliable? To what extent we can rely on that? Sometimes, it could be misleading. But if the company has got good internal financial control system, it will announce what internal good financial control system the company has. And the stakeholders will be assured because the company has good internal financial system which focus also, to a larger extent, comply with the statutory requirement. This is another very important thing. And all of you know very well that today we know about IFRS and International Accounting Standard Board and International Accounting Standards have taken the initiative to harmonize Indian accounting standard with a international financial reporting standard. This is in the public interest and to set a single set of high quality, understandable, enforceable, and globally accepted financial reporting standards. What is shareholders' wealth, my dear friends? What is shareholders' wealth? Shareholders' value, we say shareholders' wealth. Market value of the share. What do you mean by market value? Share price of listed company, and where the market is very active, where the share of the company enjoys the required degree of liquidity. What do you mean by liquidity? Marketability of the share. When the share of the company is constantly bought and sold, there is price formation. And the company which is very good company will be the most sought after company names. It will come down also due to so many reasons. I'm not going to touch on all that you have studied on. So what I'm going to say, the share price will go up when the prospects of the company are good, when everything is going good. You know very well that in stock market, there is something called psychology, expectation of the shareholders. And because of the market sentiments, as reflected through the psychology, the psyche of the investors, and to a larger extent, these speculators also contribute. Anyway, I'm not going to dwell too much upon that. The share price will go up and come down. Active shareholders watch the market value. However, even in spite of the share price going and coming down, they will be within a narrow range. Not too much volatility because the company is good. Therefore, the share price, as reflected through the stock market quotations, is very important. And shareholders always look for the market value of the share. And you can express the value of the share. It could be present value, the future expected return. If you're talking about return to the shareholders from on their investment, when you talk of expected return, what you talk, dividend or profit from the sale of stock, dividend plus profit from the sale of stock. That is your expected return. In case you sell, what dividend you have received or going to receive, plus sale process of good companies, they got immensely rich over a period of time. When they stick to their shareholding, when they are loyal investors, I have seen shareholders of companies prospering beyond their own expectation through what is known as bonus shares and right shares. Because companies come out with bonus issue, and the existing shareholders will immensely benefit. Market activity, but the shareholders are happy because their wealth got enhanced consistently through bonus shares and right shares issued by the company. And the market capitalization of a good company will always be high, because a good company is one which is the most sought after. A good company is one where the share price goes up, up, up. And what is market capitalization? Number of outstanding shares of the company times into the market price of the share. So if the market capitalization is huge for a company, it speaks of the financial, the market power, that is the stock market power of the company. It speaks of they are, how satisfied they are, and it gives them confidence. Whereas the market capitalization goes down all of a sudden, it means that the share of that company is no more favored because the share price came down and market capitalization came down. As I told you a little while ago, every rupee saved translates to multiple rupees in market capitalization. You know very well annual report and quarterly report. I don't know how many of you have seen the actual annual report of companies. It is available in two formats, soft copy and also the hard copy. But today, as a part of the green initiative, you don't find, companies don't come out with the print version. But you can see, look into the annual report of companies, the soft copy. All students of finance should study annual report of not just one company, many companies, and quarterly reports. Because annual reports, there is a lot of scope for you to understand the company's strategy, company's performance, not just one report. You can compare the company's performance over a period of time, looking into the annual report of few years, because that will give you a time series for you to analyze. And the degree of compliance of the company, revenue recognition, risk mitigation system, what the company has, risk mitigation, as I was telling you, the procedures and controls, and not just the annual report go beyond number. They even tell about the HR policies, the degree of attrition, and the innovative HR policies which the company is coming out with. And as students of finance, you should also look into what is happening in the HR area, HR domain. It will give you very interesting inputs. And annual report also, as I told you, go beyond number these days. They also tell about their human resource, what policies the company has, and what is the degree of attrition, what is the training mechanism they have, and how they augment the revenues. And annual report will be the single window to the investors to understand the company's operations and also aspirations. The company's operations and what plans the company has. The company will believe in shared aspirations, will believe in shared purpose. It will share its purpose with the stakeholders, and it will also share its aspiration, dream with the stakeholders. It will create an excitement. It will foster a beautiful environment in the company for the team to work with motivation, sharing aspiration, sharing purpose. Anyway, and annual report will give a window to other stakeholders, wherein it will give idea about company strategy, what position the company enjoys in the market. It is very important for the stakeholders to understand where the company stands in the market and what is the goodwill of the directors, what is the reputation of the directors. Quite often, the image of the company depends on the image and reputation of the directors. Who is on the board? What is their professionalism? What is their reputation? What is their image? Was there any scam involving a director? Was any director tried under any law of the land, under any statute? These things are very important. So annual report will give information about the directors, because it gives message from the chairman, it gives a message from the MD, CEO, and directors report, board of directors report will be there. And today annual report also, as I told you, go beyond number. It will also give stock price movement. Your company need not give, but companies go extra mile to give the stock price movement also to the shareholders. And annual report also will give an idea about the different committees of the board. I think you're all aware. You see, you study finance. It is also important for you to know the provisions of the Companies Act. You know very well that the board of directors has different committees, subcommittees, and the annual report will give information about these committees. And in my opinion, this information is very important. Of course, this is a statutory requirement, but to what extent the companies are fulfilling the statutory requirement? What is the degree of compliance through formation of different subcommittees? For example, there is audit committee. There is a committee of board governance, where to what extent the corporate governance is followed. Committee for remuneration and nomination of the director, CSR committee. There's a committee to look into the corporate social responsibility aspect of companies. There is a committee to look into customer service. There is a fraud monitoring committee. There is information technology strategy committee. There is risk committee. There is a stakeholders relationship committee, company on executive directors, and so on. So annual report is an exhaustive information. It is a very, very huge set of information available, very important information, in my opinion, and good annual report, exhaustive annual report is a part of very good financial reporting, and where the shareholders are immensely benefited. And the value of the shareholding, the value for the shareholders will depend largely on to what extent the annual report is correct, to what extent the annual report is informative and exhaustive. And you know very well that financial report is a part of the company's business strategy. Today, companies know the importance of financial report. They know how important financial report is, and they consider this as a business strategy. And not just that, companies know very well that it will help, good financial reporting will help the investors and other stakeholders to form opinion about the company's business viability, commercial viability. This is very important. And sometimes the annual report may be a little complicated for an average investor. The investor may seek clarification. He may write to the company, may seek clarification regarding some of the content of the annual report. Wherever the customer or the shareholder, investor seek clarification, company has a window, company has a mechanism as a part of the internal control system to offer the required clarification promptly. And as I told you, you can just go through the soft copy of the annual report. And today, some companies give summary annual report, but it is very, very difficult to decide the level of details in the annual report. Though some companies give exhaustive report, but not all companies do it. Students, it is very interesting, I should tell you here. When I was teaching these things for my students long time back, there was no soft copy of the annual report, only hard copy. And you know what was the annual report format? It was a very thin booklet with black and white printing, very unattractive, minimal information. But today you should see the hard copy of annual report, very glossy exterior, beautiful printing, and not just the exterior beauty, the beauty of the internal information, inside information, so exhaustive. It looks like a book. But not all companies can offer maximum information, though that is why I told you it is very difficult to decide the level of details in the annual report. But today, all of you know very well, I was talking a little while ago about the shareholder activism, because the shareholder democracy is very important. And companies have realized the importance of shareholder democracy, the importance of listening to the shareholder, not just in the annual general meeting. The shareholder can write to the company anytime and seek clarification regarding any content of the annual report. All shareholders may not be learned. All shareholders may not be quite aware of, quite conversant with the financial aspects. They can take the help of expert. Definitely, they can take the help of expert. But today, shareholders, they are not passive. They are very, very active shareholders. Therefore, these annual reports, vis-a-vis the financial reporting, should keep in mind shareholder activism and shareholder democracy. Quarterly reporting is another important aspect. All of you know very well, companies talk of Q1, Q2, Q3, and Q4. What are these? Quarter 1, Quarter 2, Quarter 3, and Quarter 4. Just now I was talking about annual reporting. Now I am talking about quarterly reporting. What is this? Yes, annual reporting is there, but companies also come out with publishing their quarterly financial reporting. Why? Is it a must? I should tell you here a very interesting thing. A committee called J.S. Patel Committee was constituted in the 80s to look into the capital market aspects. J.S. Patel Committee came out with very, very good recommendation. One of the recommendations was half-yearly reporting. It said that companies should come out with half-yearly reporting. It is something like deviating from your annual examination and taking semester exam. It was something like that, which means companies were suggested to come out with the 6 months performance, place it before the stakeholders. J.S. Patel Committee said. And one company said, it is only a recommendation. One company said, what did you say, 6 months, once in 6 months? No, we do it 4 times a year, once in 3 months. And all other CEOs, they said, what is this man is telling? We find it difficult to go before the shareholders once in a year, and J.S. Patel Committee is telling every 6 months, twice a year, and this gentleman is telling we go before the shareholders. That means we disclose, we publish the information 4 times in a year. Who was that man? Mr. N.R. Narayan Murthy. He came out with this, announcement. He said that we are prepared to go before the stakeholders once in a quarter. Once a quarter, that is 4 times a year. Going before the shareholder means disclosing, publishing the information. Of course, unaudited quarterly report to be published. And today, all companies, it has become a norm. Companies which initially expressed apprehension, they soon joined the bandwagon, and today it has become the norm. And this quarterly reporting is advantageous. But all listed companies should furnish this quarterly reporting within, within 1 month of the conclusion of the quarter, within 1 month. And once the disclosure is made, quarterly reporting disclosure, within 48 hours, it should be published in 1 leading national daily and 1 local newspaper. My dear friends, I don't know how many of you meticulously go through quarterly reporting of companies. All finance students should go through quarterly reporting of companies. Very, very important, because it will give a lot of insight. When you are given a target, 3 months target, you will do definitely better. When you feel that examination is 1 year hence, yeah, you may be complacent. You may take it a little easy. Whereas if you know that you are given a 3-month target, you will do well. You race against time, you will do extremely well. Therefore, this quarterly reporting is good for companies and good for shareholders, because shareholders know fully well that company management is on their toes. They have to perform because they have a shorter target to fulfill. And therefore, today, quarterly reporting, which has become norm, is good for everyone, for the managers, for the shareholders. But some companies, they may not enjoy reporting quarterly, but the benefit is immense for everyone to see. Friends, let us now talk about what is the disclosure policy, how much to show, how much not to show, and all that. What is the disclosure policy? Disclosure policy is company will have to comply with the statutory requirement. That is for sure. But going beyond the statutory requirement, going beyond the numbers is what is important. And the financial reporting must be matter of factly, no more, no less. Not hiding information, not twisting information, not distorting information. It must be matter of factly. And the strength of the company, the inherent strength of the company, the capabilities of the company, the core competence of the company must be disclosed. It is very important. You are disclosing the number, bottom line, top line, but you should also disclose what is your strength, what are your capabilities, what are your core competence, what are your weakness, what are your opportunities and threats. You may say, sir, competitors will know your weakness. See, in my view, a winner is one who is open, who will admit his weakness. Admitting weakness is a strength. That is the attribute of a good company, where it will make proper assessment of its strength, admit, and not just that, it will also be cautious of the possible threats coming on the way. And one more thing, do not disclose to the shareholders the opinion of others. For example, some analysts give opinion about the company. Don't borrow these opinions. You disclose what is there. You disclose the real facts. Matter of factly, you disclose. Don't borrow opinion of analysts and offer to the shareholders. Here, let us look into what is a good accounting policy, what is the bad accounting policy. You have studied all this. A good accounting policy is one which focuses on key success factors and also the possible risk. But the bad accounting policy will fail to focus on the key success factors, and it will possibly cover up the risk, or it may not say anything about the risk at all. The bad accounting policy. In case of a good accounting policy, the numbers are more informative numbers. But in case of bad accounting policy, managers try to disguise the reality. Manager may try to cover up. Managers may try to indulge in window dressing. You know what is window dressing? From outside, it looks so beautiful. But you just take the curtain to your side, you will be in for a shock. The inside story is totally different. So these intelligent managers that try to give a rosy picture of their company by giving some cosmetic changes here and there to make it look like more rosier, more promising, where on the contrary, the inside story is different, the reality is different. Therefore, bad accounting policy is indulging in window dressing, disguising the information, covering up accounting information. Coming to good accounting policy again, adequate disclosure regarding its strategy, regarding correct performance, regarding the future prospects, what a good accounting policy should be doing. On the contrary, in case of bad accounting policy, the management will go for the minimalistic approach. What is just required, they do it, not beyond that. They may not say anything about company strategy. They may not say anything at all about the current performance. They may not say anything about the future prospects. And again, good accounting policy is one where there is no red flags. And bad accounting policy is one where there are serious, red flags. What do you mean by red flags? What do you mean by red flags? For example, red flags, to identify red flags, it needs, a keen observation. You need a hawk eyes. You need a totally different perspective to understand the potential red flags. What are those red flags? Some of you may be able to answer my question. I don't know, just you may know about red flags. For example, all of you know very well that auditor statement. What is auditor statement? What is auditor certificate? At the end of the financial year accounting year, the auditor, after auditing the annual accounts, will certify, stating that everything is fair, everything is correct. But the auditor may also give qualifying statement. In case you find any gray area in accounting or disclosure, he may come out with qualifying statement. In case he finds an irregularity, he will give a qualifying statement, which is very, very important for the stakeholders. So potential red flag is one where there is a qualified audit opinion. So when there is a qualified audit opinion, the stakeholders, including the shareholders, will become highly cautious. It will give warning. Red flags, it will give you warning. Don't proceed. Look, there is a danger. And another potential red flag is one, there is a change in the accounting policy all of a sudden. There is a sudden change in the accounting policy without offering satisfactory explanation. So it is doubtful why the company changed the accounting policy all of a sudden. In case the company offered very satisfactory explanation or information about its decision to change the accounting policy, it is all right. But when there is something fishy, where the company has changed the accounting policy in a hush-hush manner, not in a transparent manner, you can take it as potential red flag. And another thing is where there is sudden increase in the accruals, potential red flag. And another potential red flag is there is a large adjustment in quarter 4. What is quarter 4? The fourth quarter of the accounting year. All of a sudden, fourth quarter, there is large adjustment. It was not there quarter 1, quarter 2, quarter 3, but all of a sudden, fourth quarter. You know why? Because your financial year should look attractive, accounting year should look attractive, and you did not have good performance in the earlier 3 quarters. So all of a sudden, you want to make up for that. So quarter 4, there is large adjustment. This is another potential red flag. And one more thing, when there is a sudden change in the auditor, internal and external auditor, this should be taken as a serious red flag. And when there should not be change in the auditor, the external auditor, and internal auditor, normally there is no sudden change. But if there is a sudden change, it should be taken as serious red flag, my dear friends. Going to the next information, what are the attributes of good financial reporting? Predictability of revenue, and it should be sustainable, unsustainable. And good financial reporting should focus on matter-of-factly reporting of profitability. It also should give fair information about the risk and the de-risking mechanism. And it will give earning guidance, both the top line and bottom line. What should be the earning guidance? What should be the revenue guidance to the managers? and what should be the profit. Revenue and profit, you know the difference. And see, this kind of earning guidance will not put any pressure on the management. In fact, it will do good for the management. Management should know what is the guidance. In case they have some target, it will definitely help them. And attribute of good financial reporting is matter-of-factly reporting. Go before the stakeholders with a clean report. Admit your mistake. Admit your weakness. I will tell you, Infosys is one company which, in my opinion, has been extremely good in terms of transparency, ethical practice. Infosys has shown to the world how it is possible to earn profit both legally and ethically by conforming to high degree of corporate governance. They never shirked, they never hesitated accepting their weakness. They never hesitated disclosing the most unfavorable situation. For example, in the year 2001, everything was going good. And the sales growth was 100% till 2001, 100% sales growth. But in the year 2001, the company experts came out with projection that the sales growth will be only 30%. It is only internal information. Everybody could have just kept quiet in a hush-hush manner. But the company reported to the stakeholders in the AGM, to the stakeholders, they came out with this startling revelation. What is that? They admitted that so far the sales growth is 100%, but this year it will be only 30%. What was the repercussion? The share price, the stock market price of Infosys company share, which was hovering around 5,000 rupees, came down to rupees 1,500. The management knew about the possible implication on the share price, but the management never hesitated to accept the reality and disclose the reality, report the reality to the stakeholders. That is, my dear friends, this is very, very important. And good financial reporting system, as I told you, should also have good internal control. And here, independent auditors play a very important role. As I was telling you, it is also important for you to know something about the corporate regulation, about the provisions of Companies Act as amended in the year 2013. You should know. You should know about independent directors. Independent directors, they are not full-time directors. They don't get any salary, regular income. They attend the board of directors meeting whenever the meeting is convened. They come prepared for the meeting and to operate in the most manner, and they are almost like safeguarding the interest of the stakeholders. They are ready to express their opinion. Whereas other directors, continuing there depends on the how good they are with the management, with the chairman. But the independent director, their opinion, which goes a long way. Which goes a very long way. And all of you should know that audit committee is very important. Every company should have audit committee. And the audit committee, Companies Act, again, 2013 Companies Act says the audit committee should have minimum 3 directors. Majority of them are independent directors in the audit committee. And these independent directors will sort of whistleblowers. Who is a whistleblower? A whistleblower is one who is going to tell that, look, there is a potential red flag. There is something amiss. There is something irregular happening soon. Be careful. The independent director's job is exactly that, whistleblowing. And anybody can be whistleblower. And in other countries, the whistleblower's identity is safeguarded. There is a safeguard, legal safeguard. And this information, very important information given by the whistleblower, is going to help huge loss for the stakeholders. That is why audit committee is very important. And one attribute of good financial reporting is very good audit committee and very, very active independent director. And the audit committee should monitor the financial integrity. That is very important. And not just that, the audit committee should also look into the appointment and remuneration of statutory auditor. You should know very well that statutory auditor is very, very important. If the statutory auditor is hand in glove with the management, he will certify the annual report. He will certify the account as correct, whereas the reality could be different. We have several instances where the statutory auditor was in collusion with the management and gave a clean sheet to the company. Later, it caused an enormous loss to the stakeholders and the shareholders. We have many stories in this regard. Voluntary financial disclosure. What is that? I was telling you, going beyond number, and again, giving additional financial information beyond the minimum information as per the statutory requirement. Is it good? It has got its own competitive advantage, competitive disadvantage. What is competitive advantage? When companies come out with voluntary financial disclosure, it will place the company in good league. It will help the stakeholders to form very good opinion about the company. It will help the company to enjoy the reputation, goodwill of the stakeholders, because the company is perceived as one which has high degree of corporate governance practice. That is the competitive advantage. But the competitive disadvantage also could be there. Like the competitors will know some key information about the company. But as I was telling, a winner is always one who is going to disclose and face the consequences, you call it, or whatever it is. And another important policy here, voluntary financial disclosure, is when in doubt, disclose. If you have a doubt, come on, disclose it. Don't keep the doubt within yourself. The management should follow this, and especially I have a lot of regard for the professionalism of Mr. Narayan Murthy. That is his statement. When in doubt, disclose. And another important thing is the power of shareholder feedback. When do you think the shareholders will give their feedback? You know very well that there is annual general meeting, which is held once in a year. There could be extraordinary general meeting. That's a different thing. So it is a good platform, an opportunity for the shareholders to express their opinion in a very frank and objective manner. And good companies are one which encourage shareholders' feedback. And today, annual general meeting are taking a different dimension altogether. Those were the days when annual general meeting was very, very, very thinly attended. But today, it is well attended. But in case of a very big company, huge company, where the shareholders number run in lakhs, where do you accommodate all of them? The reality is not all of them will attend the annual general meeting, because the shareholders belong to different profession, vocation. They come from different parts of the country, perhaps from abroad. So only a small percentage will attend. And big companies hold annual general meeting, you should know, in football stadium, and where public address system is used. Anybody can hear anyone when he is given a chance to speak. The shareholders are given a chance to speak. The shareholders' feedback is very important. And companies which value shareholder feedback, it has helped the companies immensely. And today in corporate democracy, shareholder feedback should be respected also. And it is very valuable for the company. Yes. And what is the value system in financial reporting? Value system is honesty, ethics, integrity, transparency, and courage to admit unfavorable reporting. I gave the example of Infosys. And again, I should give you one more example of Infosys. In 1985, Infosys admitted in the AGM that it lost quite a lot of amount in stock market operation, stock market. You know what happened? It was very unfavorable information, and the company lost a big client. Company lost a client, a Fortune 10 company lost, Infosys lost, and that company was contributing nearly 25% of its top line, that is revenue. But why the company Infosys should have done it? That is because Infosys is driven by value system. The value system is totally different in Infosys, and that is why Infosys has got award for corporate governance practice consistently and continuously for a long time. And honesty is very important. My dear friends, here I should tell you, there is greed also on the part of managers many often, and honesty, lack of honesty. I think all of you know about insider trading. Insider trading is buying or selling shares of a company based on insider information, unpublished information which is private. Only few people are privy to this information, only insiders, others don't know this financial information, which is unpublished, very price sensitive. And when I am privy to this information because I am director of the company, for example, you are the director, what we do, highly favorable information, which is not yet become public, which is only within the board meeting. In case I buy the share of this company now, which is hovering at a particular level, once this highly favorable information about the company becomes public, the stock market price goes up, and it raises a very high level. There, I offload the share and make huge killing for myself. And the external people, the shareholders, they rely on published information. By the time they act on published information, it could be too late. So in unethical way, I will be doing profit based on insider information about the company, which is available only for me. Only I am privy to that information because I am the director, because I am an insider. You know this. And this happens when the honesty level, when value system is not there at all. Even some people, they know that they did not do insider trading, but they received punishment. They were tried under law. Who doesn't know Rajat Gupta? Rajat Gupta, an Indian, went to the US in search of Indians' American dream. He goes there and passes out from MIT and does MBA from Harvard. And he joins McKinsey. He grows to the top because of his professionalism, because of his acumen. He grows to the top, the first non-American to head McKinsey. And that such was his reputation. He was the most sought after person to be on the board of several companies like Goldman Sachs, like Procter and Gamble. And in fact, he is responsible for commencing the Indian School of Business in Hyderabad, along with his friend. That is his reputation. That was his reputation, in fact. But what went wrong? After he served his tenure in McKinsey, and in the year 2008, he attended a board meeting of Goldman Sachs. And after the meeting, he was going in his car. He received a phone call from his friend, Raj Rajaratnam, a Sri Lankan origin hedge manager. And matter of factly asked how was the, if not matter of factly, he was asked how was the meeting. And Rajat Gupta said meeting was fine. You know what happened? There is a decision. Warren Buffett is going to invest $5 billion in Goldman Sachs. Rajat Gupta, I don't know whether he matter of factly revealed this information. Raj Rajaratnam, his friend on the other side of the phone, said thank you very much. And what he did, he bought large number of shares of Goldman Sachs based on this insider information, the most recent information. Later, and you know very well, in the US, Securities Exchange Commission is very strong. There is an act called SOX, Sarbanes and Oxley Act, very strong act. The Indian counterpart of SEC is SEBI, but SEC is very strong in the US. So legal proceedings were initiated against Rajat Gupta on the grounds of insider trading, and he was served imprisonment, and he underwent imprisonment. He was in jail. And what happened to his image? A person who was on the top, glory, what a fall from grace, because there was lack of honesty. He should have been more professional. He should not have revealed this insider information. But the investigation report said that he made money based on insider information to the disadvantage of others. And there are so many stories like this, so many stories which you have gone through where honesty level is not there. And what Joseph Stiglitz, the economist and Nobel laureate, says, you should look into this. A beautiful statement. I like this statement. We have distorted knowledge of how company value is distributed among shareholders, employees, and management. How company value is distributed. The value of a company should be distributed among shareholders and stakeholders. But what we have is distorted knowledge, not the correct information. Why? Because there is lack of ethics, there is breach of trust, there is greed and erosion of shareholders' wealth. Because of all this lack of ethics, greed, and breach of trust, what happens? The shareholding value comes down. By the time the shareholders realize that, they would have lost a fortune. There are many stories to show this. Frauds are common. Where there is a lot of money, there is greed. My dear friends, as students of finance, you may become a finance manager, you may become directors finance, you may become CEOs of company. See, it is very important for us to draw a line. This is my money and that is not my money. You should draw the line. Otherwise, what happens, there will be temptation to involve in fraud. And Global Fraud Survey, I have taken from Global Fraud Survey 2012, published by Association of Certified Fraud Examiners. What the findings? The median loss of fraud cases, $140,000. And the median duration of fraud, 18 months before the fraud gets eventually detected. And in 87% of the cases where fraud is there, asset misappropriation is the reason. And one more thing is, the longer the perpetrator of the fraud is allowed to continue in the company, the quantum of loss, the enormity of the loss will be very huge. This is another important thing. And my dear friends, time is running out. I have another 10-15 minutes. We are talking about good financial reporting, but there are many cases where the accounts are falsified. I have taken one classic case, Satyam Computers. All of you would have gone through the Satyam case. Nobody could have, no finance student will miss this. Please go through this statement. This is only an abstract, what I have taken, just to drive home the point. What is the degree of falsification? What is the extent of falsification? Cash and bank balance was not there at all. But in the annual statement, it was reported to be 5,361. there was little cash. The difference was to the extent of 5,040. Accrued interest on bank FDs. There was no accrued interest, but it was reported as around 376 crores. And understated liabilities. You know very well that liabilities are those where the company owes to outsiders, obligation. Actual liability was 1,230 crore, but reported was nil. So difference was 1,230, where the company actually owed, but it was covered. It was shown as if the company need not owe anything to outsiders. And debtors, overstated debtor. Debtors are asset, where the actual was 2,161 crore, the reported was 2,651 crore. Again, falsification of account to the extent of 490 crore, all totaling to 7,136 crore. And in addition to that, the Q2 financial year 2008-2009, whereas the actual revenue was 2,112 crore, the reported revenue was 2,700 crore, difference is 588 crore. See the extent of falsification of account, which to the tune of 7,724, nearly 7,800 crore. And as a result of this, there was serious erosion in shareholders' wealth. The Satyam computer, the share price was very good, 544 rupees in September 2008. And what happened? In January 10, 2009, it plummeted to 11.5 rupee. How much loss? 98% approximate loss, 98% loss in a matter of 3 months. What helped shareholders to detect this? Shareholders would not have realized this. The falsification would have continued. But what happened? Whistleblowing. But this Ram, I think I need not give you the detail of this case. All of you are aware. Ramalinga Raju, who started this company in the year 1987, did extremely well. In the year 1992, it was a small company with 20 employees. In the year 1992, this company went public, listed on Bombay Stock Exchange, and was also listed on New York Stock Exchange. The company did very well. So much so that Ramalinga Raju was recognized for his professionalism, and World Council of Corporate Governance recognized this company with the Golden Peacock Award. You should know, this is a very important award. And Satyam had many companies, Fortune 500 company as his client, and 185 client of the Satyam computer were from Fortune 500. You can just imagine the reputation of the company. But what happened? The greed made Ramalinga Raju to indulge in this falsification. He wanted to make money for himself. He floated two fictitious company, Meta's property and Meta's infra. Meta's is, you just reverse Satyam, it comes to Meta's. And this would have gone unnoticed. What happened, as I was telling about the independent directors, whistleblowing, independent directors, how active they should be, how objective they should be. And here, I should tell you, the independent directors of Satyam, because of them, this falsification of accounts were brought to notice. Otherwise, this would have gone unnoticed. Who are those independent directors? There was Vinod K. Dham, father of Pentium, and there was U.S. Raju, the former director of IIIT Delhi, Mr. T.R. Prasad, former cabinet secretary of Government of India, Srinivasan, former professor, and Professor Krishna Palepu, professor at Harvard B School. These were the independent directors. And Professor Krishna Palepu just sends a mail to other independent directors about the misdeeds of Ramalinga Raju. And the independent directors, they become very active. and Ramalinga Raju gets sent off, the internal mail going amongst the independent director, and he knows for sure that the writing on the wall is very clear, and he wanted to preempt the possible implication under SEC US. So he goes before the public, and again, around that time there was a global financial crisis, subprime crisis, and he admits his falsification of account, and he says sorry. And the share price, that happened in January, the share price, as I told you, which was hovering around 550 rupees, 544 rupees in September, came down to 11 rupee 50 paise. As I told, 98% erosion in the shareholders' wealth. You have a lot of other cases. For paucity of time, I'm not going to all that, but Enron is one important case. Enron, which is a company, energy and a power-based company, which did extreme level, the seventh, the largest US company. And all of you, I think you read the book of Jeffrey Skilling, his approach, how cutthroat he was, how tough he was, and how greedy he was. He was tried, and his predecessor Kinley, and he died while he was being prosecuted. All these stories you have seen. But one thing here you should know, my dear friends, what the auditors were doing. What the auditors were doing. Who was the auditor of, say, Satyam? Who was the auditor? You know, PwC, PricewaterhouseCoopers were the auditors, one among the big four. The big four, PwC, KPMG, Deloitte, Ernst & Young, and PricewaterhouseCoopers were the auditors of Satyam. What they were doing, what they said is, we largely relied on the information provided, internal information provided. We largely relied. That was escapism. And they said that we are a reputed company. We don't do all this. But SEC came heavily on PricewaterhouseCoopers because there were international investors. And unfortunately, SEBI in India took long time, 10 years, almost 9 years, 9 to 10 years to come out heavily on PricewaterhouseCoopers, where it said that this company cannot take up auditing of any listed company in India for 2 years. That was a very small punishment. But in my opinion, statutory auditors should do their job very well. PricewaterhouseCoopers did nothing in identifying the red flags, and it looked like they joined hands with the management of the company. And in case of Enron, Arthur Andersen did a very bad job. Of course, the company, Arthur Andersen, is not there at all because of the bad reputation. They got such a beating that the company went into oblivion. And there are so many other stories, my friend here. And internal auditing, external auditing, and they should not be complacent to the fraud. They should be very proactively looking into the possible irregularities. And I just told you about PwC and Arthur Andersen and Security Exchange Commission of the US and Public's Companies Accounting Oversight Board also find PwC to the extent of $7.5 million. And another important information, my friends, investor confidence is very important. Once the investor loses confidence in a company, it is very difficult for the company. Therefore, what is important is ethics, integrity, transparency, and accountability. The strength of any company is enjoying the confidence of investors. And after all, investors prefer a respected corporate body. The bottom line is getting redefined. Thank you, my dear friends. Any question?
Students, you can ask questions if in case you have doubt towards so any concept you can ask for clarification.
Good morning, sir.
I only hope. Yeah, please come, please.
Sir, just now you spoke about investors' confidence and as well as the transparency to be maintained by the company.
Yeah,
Is it mentioned in the statutory regulatory that transparency has to be maintained?
definitely. See what the statute wants. The statutory provision are drafted in such a way that what is important, investor protection. For example, what SEBI does, what is the prime agenda of SEBI? Investor protection. So all statutory provision in this regard, keep in mind investor protection as the prime agenda. Therefore, when we are talking about the disclosure, financial disclosure, what is important is investor confidence, protecting the investor, safeguarding the investor, because the investor rely heavily on the financial inputs as reported by the management through their financial statement. Therefore, transparency is the assumed aspect, expected aspect, but it is assumed that it is there. But in reality, transparency, the degree of transparency seriously differs between companies, between organizations. As I was telling you, those organizations which steadfastly committed to value system by offering high degree of transparency, they are respected, and you can find investor loyalty there. Investors always go for such companies. There are so many companies. I suggest you take up your own case study, go for companies where the investors get out of the investment, what percentage the investors are loyal with the company. You will get an idea why they are with the company, because they respect the company for the transparency. And on the contrary, when there is an exodus, shareholders go out of the company by selling their investment in a large number, which means that it is an indicator that there is something serious. There is no transparency. There is a distinct lack of transparency.
Thank you, sir.
Was it a useful session? I would
Yes,
like
sir.
Yes,
to
sir.
Yes, sir.
Yes, sir. Know from you. I would like to, because I am a teacher, I am an academician. I would like to know only when the participants are having some takeaway. My job is done. And I suggest to all of you, all the participants here, please take up case studies of many companies. Each case study will offer very important inputs, very important, useful insight, which will go a long way in shaping yourself as a very effective financial professional. Thank you. I think it is time, 11:30 exactly.
Oh,
Yes, sir. Thank you, sir. Thank you for the wonderful session. Now I would like to hand over the session to
Thank you.
Chetan to conclude.
Good morning to everyone. It's been such a beautiful session where we have such an eminent resource person, Dr. V. Prabhu Dev, sir, with us. Thank you, sir. I would like to thank our beloved Dean, Dr. Bindanamia ma'am, for organizing this kind of events. And I would also like to thank our event coordinator, Professor Nityananda, sir. The session was with lot of inputs of how exactly maximizing shareholders' value through good financial reports. The session includes the corporate governance practices, the financial reports used by the organizations, how the profitability of a company attracts the shareholders, It also included about the corporate excellence, intrinsic value, the positive risks, the financial positions, and degree of transparency. At present situation, it also talks about how important the human resource is, the importance of internal control system, and the present financial reports. It also includes the provisions, the committees framed, the board of directors, and the top officials, the share value movement, and the session majorly speaks about the accuracy of annual reports. We also got to know about how a company should disclose few things, and a good financial attribute statement should have the profit and loss account, earning guidance, the provision, revenue, facts to be known, and it should be a clean report. And a company should also admit its weakness and defaults. For example, we have a live example of Infosys, and the importance of shareholders like the annual general meeting, the shareholders' powers and importance, and the shareholders' feedback. And the session also talks about the insider trading and the fraudulence happened. An example of the Satyam computers, and the and it also talks about the impact of misfraudulence and financial reports, how it affects the market price. I would like to conclude by saying it's always seems impossible until it's done. I would once again thank Dr. V. Prabhudeva sir for sharing such a valuable information. Now I would request Professor Nityananda sir to deliver the vote of thanks. Thank you, sir.
Thank you. Thank you. Thank you very much. All the very best. All the very best.
So, wait a second, sir. It's an honor to offer a vote of thanks on this occasion on behalf of MQI College and the entire management. I would like to thank our guest, Dr. Prabhudeva, sir, for sharing their wisdom words with us in today's lecture. I would like to extend my thanks to our
Thank you very much.
Honorable
It is my
Dean Ma'am,
pleasure.
Bindu Nambiya,
Of you.
for their continuous support and conduct this kind of valuable sessions. I would like to thank our fellow mates and
Thank you.
students for their active participation. Once again, thank you, Prabhudeva sir, for your time and valuable words. Thank you all.
A small correction. My name is Dr. V. Prabhu Dev, not Prabhu Dev.
I'm sorry, sir.
It's all right. It's all right. It's all right. So it was a nice session. All the very best to all of you. We'll meet again. Thank you very much. Thank you.
Thank you, sir.
Thank you, sir.
Thank you.